The breadth of coverage dedicated to unpicking the causes of the software sell-off and its broader implications would suggest the world is on the brink of a global equity market collapse. We think this is a long way from the truth. Equity markets have had a strong start to the year despite many concerns. Most recently, a significant derating in global software stocks that has infected the Australian market. Despite a long list of concerns stretching from Donald Trump being Donald Trump, to rising geopolitical concerns in the Mideast, to fears around overinvestment within AI, and then equity valuations in general, markets have been extremely resilient for the most part and continue to creep higher. But headline index levels are slightly misleading because there have been significant divergences in the performance of stocks and sectors. For instance, the ASX 200 is up 2% year to date, but Australian value stocks have risen 6% and Australian growth stocks are underwater. Expressed another way, the Australian energy and materials sectors are up around 10% year to date and tech is down 17%. In other words, markets have moved higher, but below the surface, we've seen a dramatic rotation into stocks and sectors which have strong valuation and earnings appeal, and out of stocks and sectors where valuations are extreme or the earnings outlook less certain. And we've seen profit taking in areas where price momentum has been very strong. Rotation is not unusual, and it's something fund managers have to deal with regularly. But the difference this time around is that the market is flip-flopping between different stocks, sectors, and styles, and this is causing huge price swings and volatility. Unfortunately, in a market that is liquidity and momentum driven, this is likely to remain the case until there is greater valuation cushion or until some of the broader market concerns dissipate. Although markets feel like they are under constant threat of disruption, equity market fundamentals are solid, and we think they will remain a positive tailwind throughout the year, even if month-on-month volatility remains high for a number of reasons. First, the global economic backdrop is expected to improve modestly as tariff concerns dissipate and inflation moderates. Second, global liquidity conditions remain easy and should be supported by further policy rate cuts by the Fed. We also think the Fed put is back in play given where inflation lies. Third, corporates should post another strong year of earnings growth as cyclical sectors pick up and sectors benefiting from structural tailwinds such as IT and commodities remain strong. Fourth, while there are many concerns around AI investment and areas that are vulnerable to disruption, we think the positive tailwinds around productivity gains will outweigh concerns at an individual stock level. Taken together, we think these are enough to offset downside risks, which will come and go throughout the year. For Australia, while the RBA is now in a rate hike cycle, this should not prevent a modest cyclical upswing, with the A-dollar continuing its ascent at least into the mid-70s versus the US dollar. In addition, and despite concerns around equity market valuations, we doubt this will prevent the ASX from posting an average year gain in the region of 10 to 12% as liquidity and the desire to buy the dip eventually outweigh other concerns. There is a qualification. A strong market return is likely to hide huge performance dispersion, and so picking the right stocks and sectors will be more important than usual. We still like the structural tailwinds for commodities, and we are not bearish on Australian tech despite its recent weakness. Higher rates will take the upside surprise risk out of rate-sensitive areas, but industrials are well placed for a private sector upswing.